company doesn't automatically mean it's foreign source because it's been generated in the country. So Liam should pay Costa Rican corporate tax on the Hong Kong company and personal taxes in Costa Rica based on the amount of time he's spending there. He's a tax resident. Now, that's what the technical tax literature says. In reality, Costa Rica is very unlikely to find out that he's running the Hong Kong company from Costa Rica because he's working online. He's, to a certain extent, Costa Rica are grateful that he's renting Airbnbs and surfboards and putting money into the local economy. But the reality is, in this situation, he doesn't have a legit 0% tax strategy. He's just sort of banking on the fact that Costa Rica won't find out. But technically speaking, he's committing a bit of tax evasion. Now, this is the same in a country like Thailand, which is a really popular choice for entrepreneurs. It gives a tax exemption on foreign income, assuming it's not remitted, meaning that it's not brought into a local Thai bank account. And so income is exempt if it's foreign source and it's not brought into Thailand. But if you're living in Thailand and you're running an offshore company and you're the sole director and shareholder and you've been earning that money whilst you're in Thailand, then it's not technically foreign source because you've been running the company from Thailand. So it's technically taxable in Thailand. And again, the reality is that this often isn't enforced, particularly for those on tourist visas. The Thai government or the governments don't have the resources to research and combat this. Who knows what AI might change for that in the future. And again, they're also not incentivized to go after all their foreigners living there because they get a lot more benefit by having these foreigners living in Dubai, living in Thailand, renting apartments, putting money into the local economy than they would by taxing them, and they don't want to drive them out. So that's not a free pass to do it. In this situation, you're still on the wrong side of the tax law. I'm just sharing the reality with you. Now, if you're a passive shareholder and you're not managing the business day to day and you're receiving dividends generated overseas, so you're living in Costa Rica or you're living in Thailand, there's a business that you set up originally, but you're not involved in the day-to-day anymore and you just own it and you receive passive dividends. Now that is truly foreign source, and then this setup would work beautifully. But the only thing you need to consider in that situation is where the management team is based and ensure that the business tax residency remains in whichever jurisdiction you've set it up in. Okay. Hopefully that all made sense. Now let's look at the Hong Kong business and then doing this really incorrectly. So let's take Steve. Steve is from Australia. He's tired of paying Australian taxes, and so he wants to move his business to Hong Kong, but he really likes Australia and he doesn't want to leave as a tax resident. So he won't pay any corporate tax in Hong Kong on the basis there's no Hong Kong source income. As Steve isn't going to spend any time in Hong Kong, he's not going to be a personal tax resident there, and so he doesn't need to worry about what the personal or capital gains tax rates are. He doesn't want to leave Australia. He just wants to avoid paying Australian taxes on most of his profits. Hong Kong has 0% tax on crypto, but that's irrelevant because he's not spending any time there. And I know I'm repeating myself, but I'm just trying to drill into you that just because you set up a company or just because Hong Kong doesn't tax your crypto, that's only relevant if you're living there. What matters is where you live. And so he continues to spend most of the year in Australia. So that means he's an Australian tax resident. So he pays personal and crypto taxes in Australia. But Australia is a residency-based taxation country, and it's going to tax Steve on his worldwide income. Now, Steve thinks he's being clever because he's leaving all of his profits in the Hong Kong company and hoping Australia won't find out. But Steve is running that Hong Kong company from Australia. So under management rules, the Hong Kong company should be paying tax in Australia as an Australian company. And if he hides the Hong Kong company from Australia, he's committing tax evasion, which is a crime. Okay? So that's an example of you setting up an offshore company, but you're not managing your personal tax residency and failing to take into account the relocation of your corporate tax residency based on your own tax residency and where you're running the company from. Okay, so let's look at a slightly different example here because Steve thinks he's clever. Okay, Steve's from Australia. He doesn't want to pay tax in Australia, corporate tax, so he relocates to Hong Kong. Now, he learned that he can't do that under management rules, so he gets a couple of mates to be directors of the company so he can say that he doesn't manage it from Australia. So, same before, company won't pay any corporate tax in Hong Kong. Steve doesn't need to worry about the personal taxes in Hong Kong because he's not living there. He's just going to keep the Australian company. He's just going to keep the Hong Kong company and keep living in Australia so he doesn't pay corporate taxes in Australia. Hong Kong has 0% tax on crypto, but it's irrelevant because he's not living there. He's living in Australia, so he's paying personal and crypto taxes in Australia. He continues to spend most of the year in Australia. Now, Steve thinks he's beaten the system. By having other people as directors, he can say that he doesn't manage the company and he's just a passive shareholder. Now, the Hong Kong company racks up profits that don't get distributed. Now, remember CFC rules. Australia can tax the undistributed profits that are sitting in the company as if they were all paid out to Steve as dividends and tax them at personal tax rates. And so there's the question of will they find out? If he hides the Hong Kong company from Australia and doesn't declare that, then he's technically committing tax evasion, again, which is a crime. And this is why it is almost always necessary to move country in order to change your personal tax residency to take advantage of these offshore setups. Okay, let's look at pass-through entities now. There's just a few more examples to go. So you might have heard of people using US LLCs or UK LLPs in their setup. Now, these are a common choice to be included because they can be set up fully remotely, they're based in reputable jurisdictions, and they give you access to strong banking and payment processing options. They're called pass-through entities because while you get separate legal liability, meaning if you get sued, you're limited by the company's liability, not your own, these entities aren't taxed in the UK or the US on the basis there's no operations there. Now, a lot of people have UK LLPs who live in the UK, and there's a lot of people who have US LLCs that live in the US. These aren't tax-free setups. But if you're not from these places and you're not living there, these can be very advantageous tax vehicles because as long as you don't have operations there, you don't need to pay taxes there. Why? Because the US was never going to tax your business anyway with you living in wherever. But with this way, you have to pay a fee to set up the company, you have to pay a fee to the registry every year, and then you're putting money into the US banking system, which is good for the dollar. Okay, so what does no local operations mean? You can have customers there, that's generally fine, but you can't have employees, freelancers, offices, warehouses, or do work yourself from there. So you can set up the company there, but there's no activity there. Now, in that scenario, all the profits are deemed to be passed through to you individually, so there's no corporate tax. And if your personal tax setup is optimized, then you're paying 0% personal and corporate tax too, making it a very advantageous tax structure that doesn't require you to physically visit the country to set up. Now, there is some nuance to this because different countries treat pass-through entities differently. If you live full-time in a country, they can be treated as local companies and you can lose the tax benefit of the pass-through. Same thing, these entities, management rules apply to them as well. And there's a lot of different ways they can be used as part of an offshore setup. Some people use them as payment processing entities to receive revenue and then send money to their main company, like in Dubai, because the payment processing and the banking options are better in the US than Dubai. Others set up a company in Dubai to get them the personal residency and the bank accounts, but then they only use the US LLCs for their business to avoid the 9% corporate tax. Now, again, these individuals need to be careful that the LLC doesn't get deemed a UA company and taxed at 9%, so it depends on the amount of time they're spending there. Okay, last couple, Portuguese tax residents. So this is just a solely crypto example. Jose, he's from Spain. He decides to relocate to Portugal to take advantage of 0% taxes on crypto. He's a freelancer. He earns 5K a month, so he'll minimize his taxes as much as possible by setting up a Portuguese company. But for him, it's most important just to avoid paying taxes on crypto. Portugal treats crypto as a currency, and so doesn't tax it if you're an investor. Now, if you're trading crypto, they're going to consider it as income, and it's no longer be tax-free. So this is why the investing definition is key. By moving to Portugal, he leaves Spain as a tax resident, and he's only going to spend minimal time there per year. He gets a local ID card, and he sets up bank accounts and new crypto exchange accounts in Portugal. He's still paying some tax on his income, but it's similar to Spain. However, he'll pay 0% tax on his crypto gains at the end of the bull run, potentially saving him huge amounts of money versus continuing to live in Spain. Now, depending on when he bought his crypto, he might need to avoid going back to Spain for 5 years if he had his crypto when he left Spain. And this is going to be similar for Germany or other European countries, similar setup, like relocate there, you'll pay income taxes there, but you will get 0% tax on crypto. Okay, let's look at getting tax residency in less than 183 days or 6 months. I mentioned in the first video that 183 day rule is something that people throw around a lot. But as I said, it's not actually a hard and fast rule. It's just a guide. It's a good rule of thumb, but it's not a concrete rule. So there is a provision in the Portuguese tax code that says even if you don't spend 183 days in Portugal, you can still be considered a tax resident there if you maintain your home with the intention for it to be your permanent residence. And so we talked about the grey area. We talked about judgment calls. This is where judgment starts to come in. There's no clear-cut definition of what constitutes a permanent residence. At which point is a home considered a permanent residence? It is a judgment call. Can an Airbnb be considered a permanent residence? Yes, it could, but it could also not. You can argue it either way. As I mentioned before, the most secure setups often involve someone living in one place with low taxes for the majority of the year, as there's little space for judgment or interpretation. But I just want to hone in that the 183-day rule isn't a concrete rule, that you can get tax residency by spending less than 183 days, and this is where the judgment starts to come in. And so when you start stacking judgments together, this is where you can get complicated, and this is where it makes more and more sense to get a custom plan put in place, because the worst thing to do is to accidentally commit tax evasion. Now, if you go and live in Dubai for the whole year, there's much less margin for interpretation, but a lot of people don't want to spend the whole year in one place, given the flexibility and freedom that most entrepreneurs have. Okay, so those were just a handful of examples so you can see how these rules and setups start to come together. As you might be able to imagine, there are thousands of different combinations possible depending on where you want to live. And it can get complicated and overwhelming pretty quickly. But I hope that has helped bring things together for you and made the landscape of tax and offshore setups a little clearer. So let's look at some next steps and recap. So a good initial question to ask yourself if you're serious about going offshore is, would you prefer to live in one place for the majority of the year? If so, and you're only looking to optimize crypto taxes, then maybe Portugal, El Salvador, or Malaysia could be good options. If you want to live in one place for the majority of the year, but you also need to factor in a business setup, then Malta or Dubai could be great options for you because they have low corporate tax rates too. Or would you prefer to spend 2 to 3 months somewhere to get tax residency and then spend 3 months in 3 other countries? If so, then Dubai or Cyprus are great options for tax residency, and you can add other entities down the road to get closer to 0% corporate tax overall, and maybe some additional personal banking elsewhere for some crypto offboarding. Okay, a couple more things to consider. So this goes back to the video at the end of the crypto section, but it's important to reinforce. So consider your current situation. Do you meet the no-brainer requirements to move offshore? How much tax are you going to let the government tax you before you do something about it? Consider your goals and the places you'd like to live. What are you primarily optimizing for? Crypto taxes, business, surf, weather, all of the above. Would you prefer to live in one place for the majority of the year, or are you open to spending somewhere between 2 to 3 months to get tax residency and then spending 3 months in 3 other countries? And as I said, if you're serious about saving taxes and changing your situation and you're willing to spend at least 5K, book an initial 30-minute consult and we'll get a plan started. If you're in the mastermind, there's a dedicated channel available to ask questions around tax, offshore setups and banking, and I'll be in there regularly. I hope that this was useful and this painted a picture for you of how these offshore setups, 0% tax on crypto, international tax setups work. You know, it is complicated, but it is possible to find a path through. But there is a lot of misinformation online, and there's a lot of people saying things or overly simplifying things that have a lot of nuance to them. So I really encourage you not to rush into something. And I also really encourage you not to move solely for taxes, at least long term. Like, there is far more to life than just taxes. So consider moving somewhere and consider the lifestyle that you really want to live, and then try and integrate a tax strategy with it. If you don't like Dubai, don't live there long term just to save taxes, you know. Maybe live there for a bit, cash out, go live somewhere cool if Dubai isn't cool to you. Anyway, hope that was useful. Any questions and you're in the mastermind, feel free to ping me in that chat.